Welcome, everyone. Welcome to the Hurley Investments 2020 results by protecting your portfolio. My name is Kevin Hurley. I'm the managing partner, and I probably want to spend 30 minutes with you to show you exactly what Hurley Investments was able to do last year by protecting people's portfolios. Now, plain and simple, in 2008, we learned that we're in a new normal, a new type of market that moves faster than before and has huge swings, things that have happened or that haven't happened since the Great Depression era. I need to have you ask yourself a couple quick questions. Am I still doing what's been done for the last 150 years by going into funds? Is my advisor, my money manager, doing something new in this new normal? In plain and simple, my goal is to have you call the number at 888-287-1030. Today, I'm going to show you exactly what we did to protect portfolios. I'm going to show you some results. I encourage you to stay the whole time. Our results get better and better as we go on. Plain and simple, occasionally you have flat days in the market. If you take a look down here at the bottom where I'm going to highlight in yellow, it's a pretty flat day. The S&P 500 is down 0.06, 0.6%, hardly down at all. How neat is it there on that code investments to be up $72,000 on a flat day in the market? That's a 1.33%. My non-student group, 178,615, it's a 1.27. The no Parker group, 141,000, roughly 0.92% up on a flat to slightly negative down day. The reason why I'm showing you this is because I'm going to show you a couple more that I hope give you a reason to dial that number on the left-hand side to make a change with what you're doing. Sometimes the market's down 0.48%, almost a 0.5%. And on this particular day, the no Parco is up 13,930. It's maybe not too impressive, only being up 0.3%. But that sure beats being down a 0.5%. And a 0.5% in this portfolio would have been roughly $75,000. We have another day where the S&P is down it's down 1.71%. That's a pretty good down day in our stock market. 1.7%. We have all accounts on this one. We're up 150 bucks. It's nothing to brag about, but it sure beats being down 222,000 if we were down that negative 1.71% like the stock market is. I'm going to keep suggesting that you guys take a quick peek and do some consideration on what is your stockbroker doing for you. Are you ready to be told? Just hold on. We have another one. Stock market here is down. The SPX is down negative 0.29, 0.3%. We're up $40,000, which is actually 0.3% up. Another day, code investment, the second one there, up 13,201 on that same probably 0.29% down day. Occasionally, we have some horrific days in our stock market. If there's something we've learned, stocks fall down much faster than they ever go up. On a negative 5.17% down day, this 11 million was only down 41,000. I'm saying only down 41,000 because it should have been down if it was matching the S&P 500. This account should have been down $568,000. We've got another one, another 1.7% down day, no Parker, only down $2,000. Only down $2,000. It should have been down at least $170,000, $180,000. If this is interesting to you, if you want to talk about exactly what we're doing, I'm going to show you. But if you want us to go over your portfolio and show you what we're doing and how we would do it to your portfolio, give us a call. It's that number on the left, 888-287-1030. I'm going to go back to a 4.42% down day. Has your portfolio ever, on a 4.42% down day, been up $1,978 on an $815,000 portfolio? How about that same 4.2% down day has a $266,000 portfolio? Ever been up $3,992? How about a $325,000 portfolio up $2,929? A $265,000 portfolio, it's only up $236, but it's up on a 4.42% down day in the stock market. You can't get these returns doing what's always been done. A 60-40 mixed portfolio, a time horizon portfolio, a retirement time horizon. A fund cannot deliver these type of returns for you. Are you looking for something more out of what your portfolio manager is doing for you? Guys, we have one right here. Kevin, it's a 1.29% up day. I get it. It's a great day in the market. Have you ever seen the market up 1.2% and your portfolio is up 4% plus? If you're looking for these type of returns, I need you to write that number down and give me a call. Some general end of the year, kind of nice to see on groups of accounts we were up significantly in that 33% range, but I want to go over 3 problems that we typically solve for our clientele. The first thing we teach you is averages aren't your friend. We will protect your stocks, and we're going to dollar cost average your portfolios without ever asking you to add more money to your account. Reason why I go through averages aren't your friend. We need you to understand where Wall Street and the stock market might be taking you for a ride, where they're going to be doing things that are not going to help you out. I always tell the story of $1. What if you had $1 with a 50% gain and then a 50% loss in year 2? These ranges happen all the time in 2-year, 3-year, 4-year, 7-year periods of time. What if you had a 0% gain? 0% average return, up 50%, down 50%. How much is your dollar worth? More often than not, when I ask that question, my answer is $1. Of course, because it's a 0% return. When we hear that, we think, hey, dollar didn't make anything, didn't lose anything. And guys, this is the first way that I push my clientele to understand averages don't matter. Because in all honesty, it might be worth $1, but it's probably worth a lot less. Do the math. A 50% up day, 50% up year, 50% up 2 or 3 years makes that dollar worth $1.50 that you invested in the stock market. 50% down over the next 2 or 3 years, that $1.50 now becomes 75 cents. Please understand that a 0% average does not mean that your portfolio hasn't gained anything, hasn't lost anything. It is most likely down 25%. In 2020, we had our stock market down at the worst, 28.86%. A lot of people last year were only up 1, 2, 3% or down 1, 2, or 3%. From the lows, the stock market came up 44%. But take a look at what's happened. A 30% loss requires a 43% return on that money to get back to break even. We were down 28.86%. We had a 44% rise. Our stock market last year was up 14.44%. Plain and simple, a lot of people never got back to break even because the drop was so significant that they had less money to make it back. I challenge you to go through some of those numbers. I asked some of my clientele if I could redact some of their information, but show a couple of returns. I'm going to show you a bunch of returns today. And I'm going to start down low. A 31.22% return on a 14.44% year in the stock market last year. The neat part is, just to show you really quickly, when the stock market was down 28.86%, we were only down 8.4%. We bought insurance on some stock positions. We made up 20% of the downward movement. When you add that 20% to the 14.44, that's how we beat the market, and we're up 31%, or doubling last year's market return. It's pretty interesting because this portfolio, plain and simple, this was a $800,000 gain in this particular portfolio. I'm going to tell you that meant something to this individual. We had a 33.12%. The portfolio was down 12.62% when the market was at its worst at 28.86. Again, this is roughly a 16% difference. It's a 16.24. You add that 16.24 on the 14.42, that's how we're coming up with a portfolio that was up $79,000 last year on a $275,000 portfolio. A 35.52%, only down 7.43% when the stock market was down 28.86. It's a 21.52% difference. You add that on here, guess what? You now see where we're coming up with the difference in these portfolios. Because we're making up some of the downward movement, that is outright being added to the market return, which gives us this better return of a 35.52%. And this particular account, it was a $45,000 return on a $125,000 account. 37.9%, down 10% on a 28% drop. Look at the chart. We had some exponential returns right here. How are we doing that? I'm going to show you, but a 37.9% return in last year's stock market. For this individual, it was a $167,000 gain. In this case, it was a pretty good gain on a $45,000 portfolio. These are what we're looking for our clientele. We tell you we protect stocks. In all honesty, as we're looking at what's happening, my job is to protect you from jumping off the cliff. I don't ever want to have to tell you, just hold on. And the bad part is, if you jump off the cliff, you can't ever get to back here. If you're trading retirement accounts, 2008 ruined hundreds of thousands, if not tens of millions of people's retirements. You cannot afford to do that. In fact, most people don't even understand what the market is doing. I'm going to bring in a chart here. I hope you understand that for people like me that started investing in 2000, the stock market, the S&P was at 1,500. It took 20 years to pass above 3,000 and keep going higher. 20 years to double your portfolio. Most people need their portfolios to double much faster than that and able to get the retirement that they want. If you invested there or you invested down here, there's between a 10 to a 13 and a half year period where we had a lost decade in our stock market. We can't afford to just hold on. We can't afford to just wait it out. We have to do better than that. is your money manager. Some things that people need to understand. Stock ownership, you buy to open your position. You buy to open shares of stock, however many you want to buy. When you think, what is the risk of that stock ownership? I hope you answer to that question every freaking penny. How do typical brokers combat the risk of stock ownership? Whether it's in a fund, individual stocks, all kinds of weird things that people are doing. Diversification. We'll just throw it at a lot of things. Well, for crying out loud, we had a pandemic last year. Everything went down. 2010, 2008, 2000, 96, 93, 90, 87, everything went down. Diversification is not protection. It's not fair for you to wait it out. You shouldn't be paying a money manager to tell you, oh, just wait it out. Trying to buy and sell stocks, losing game. You can't time the market. And an asset allocation, if you're in a 60-40 asset allocation model, I hope you understand 40% of your portfolio is making somewhere between 0.27% to maybe for 30 years it'll make 1.78% for a 30-year period of time, year after year after year. If you're in a 60-40, 40% of your portfolio won't even make the money manager's fees, and 60% has to somehow beat the S&P 500. Guys, it doesn't work. Call me and learn how we're using the long put. We're using the right to sell your stock at a certain price for a certain period of time. We're using this put, this right to do so, as an insurance contract on your stock. It's a net debit. You're going to pay a little bit more on your stock positions, but time is your friend in this trade. What does it do for portfolios? It gives you a 42% return. When the stock market was down 28.86%, we were only down 4.9% using this protection in people's portfolios. In fact, this is a 24.77% different. 25% better return in this portfolio. For this particular person, it was only $31,000. Not a bad return on a small account on how'd I say it? On a $60,000 portfolio. Pretty amazing. 44.13% return. Only down 12.12% on 28%. Guess what? It was a $210,000 return on a $457,000 portfolio starting the year. 44.69%. Almost looks like we're up between March and April a little bit. Only down 5.13%. Beat the market this month 23.73%. We're killing it. You know what's even better? This gives you a huge economic and exponential growth on your stock positions. What we're doing, and I'm going to introduce it to you in just a second, we're dollar cost averaging without asking you to put any more money to work. I'm going to want you to take a notice on how big the chart gets. I'm going to go over exponential returns pretty quickly here, but in this particular portfolio, we're looking at a $154,000 gain on a $308,000 portfolio at the beginning of the year. 46.59, same thing. Not a bad return. We made $233,000 on a $473,000 portfolio. Kind of neat on this one, if I can show you. I'm showing you stock positions. We hit on Baidu, Apple, Disney. Great opportunities here. All of this hasn't hit yet. Visa didn't really move. Boeing didn't really move. Facebook, Under Armour, JP Morgan, Bank of America. We have a lot of positions that could still move and move significantly next year to get these kind of returns. Kevin, what protection are you doing? Explain to me how you're doing that. Well, back to the stock. If you spend every dollar or spend $1 on stock. We want to buy protection. Protection can cost you as much as 7 cents. Yes, we're increasing the cost basis of buying your stock. For every dollar you put in, you might spend $1.07 for that protection. We're putting that protection on at the most volatile times, primarily around earnings events, when stocks can move anywhere from 15 to 40% of their value in a week. The more probable times that stocks can move, we're adding protection. The stock then falls to 50%, but we still have purchased the right to sell your stock at $1. What do? That protection's made 50 cents. We still have the right to sell the stock at $1. So all I'm doing, since I have that dollar, I'm spending that dollar to buy you 2 shares of stock. I'm dollar cost averaging without asking you to put more money into your portfolio. Why is this so important? Well, you've got a new cost basis now. Instead of waiting for the dollar to get back up to $1 to get 100% return on the way back up, your cost basis is just the cost of that 7 cents plus your dollar stock. Take $1.07, divide it by 2 shares of stock now. Your cost basis is 53.5 cents. If your stock moves from 50 cents back up to 53.5 cents, roughly a 7% return from the lows, you've broken even. What if that stock rose up to 55 cents, let's say? Well, you're not wildly profitable, but you have a 3% return when everybody else is still down 45%. How about it gets up to 60 cents? Well, you now have a 20% return while everyone else is still down 40%. What if it never gets up to $1 and tops out at 80 cents and looks like it's going to stay there for a decade? Well, you've just made a 60% return. We'll get out of the stock, we'll book your profit, while everyone else has to take a 20% loss. Guys, I can't explain to you how important it is to give us a call. You have got to pick up that phone, but I want you to spend 5 more minutes with me. Ask yourself if you've ever seen these kind of returns on your portfolio. I'm going to show you how protection gives you the opportunity to possibly double your portfolio in a 1 to 2 to 3 year period of time. 48.50%, only down 9.32%, $132,000 in this particular account. A heck of a gain. How about a 49.09% return? Only down 6.11% in the big drop this year. You're not going to believe this. A $456,000 return on an $845,000 portfolio last year. How about a 52.45% return? Notice how we made up this difference right here. 9.2% down on 28 cents, 28.86%, and it stays there throughout the year and then exponentially starts to grow. We probably in this portfolio added 20 to 30% more shares of stock. On a 52.45% return, this particular portfolio, it was up, hard to see, I'm sorry about this one. It was up $142,000 on a $268,000 portfolio when the year started. They just keep getting better. You've got to call me. A 55.44% return. Look at how adding 30, 40, 50% more shares of stock right here continued to increase and grow wider for exponential growth. Imagine if you had 40% more shares of stock on a 14.44% return. Add 40% onto that 14.44% return. That's how you take a stock like, a portfolio like this, a $726,000 return on a $1.213 million portfolio. Can it get better? A 57.31% return? turns out to be a $359,000 return on a $603,000 portfolio. 61.89% return. What did this one mean? How about a $309,000 return on a $502,000 portfolio at the start of the year? Kind of funny, 62.01% return. A little bit higher than the last one. $180,000 return on a portfolio that started the year out at $249,000. Is it possible to get 100% return in a year? It is. 100% return. I definitely have to explain this to you. You'll have to call me and I'll go over it to explain what happened right here. Exponential returns at the end of the year. Have you ever doubled a portfolio in 1 year? Well, Kevin, was it only $1,000? No, it's a $73,000 return on a $68,000 portfolio. You'd like to see something bigger, maybe 124% return over 2 years? Kevin, how's the 3 up there in the right-hand corner? I get it. We weren't invested. We didn't start to get invested till January 2019, when the stock market was down, going on a little bit different running average. The stock market was down 13.79 from when we started. We were up 20%. It's a 30% return. Going back and taking a look at that growth, that exponential growth that happens when you add 20, 30, 40, 50% more shares of stock. Imagine being the stock market by 300%. Blue chip stocks that you're just buying protection on. How important was it for this particular account? It was extremely important. $281,000 in 1 year. January 2020. Now, Truey's had this with me for a while. We added quite a few shares of stock. $281,000 turns into $638,000. 1 year, a $357,000 return. Why aren't you giving me a call already? Beginning balance over a 2-year period, 360. We're only at $310,000. Almost doubled the portfolio in 2 years. In 3 years, a $201,000 portfolio turns into $644,000, $442,000, or just using it as a percentage basis, which I warned you of, it's a 219% return over a 3-year period of time. I need you to pick up the phone and call now. All we're going to do is share with you what we're doing. We'll probably ask you to send us a statement of where you're at. Let us help you take a peek at what's going on with your portfolio. Let us do a risk assessment of what you're currently in. Send us an email. Send us an email that gives us a time to talk. This is the no pressure. This is just common sense. That all we want to do is show you what we're doing at Hurley Investments to help you on your path to financial freedom. I can't make you pick up the phone, but your retirement depends on it. Your financial freedom depends on it. In a new normal market, why would you ever be in a fund or some diversification plan that does nothing but throw spaghetti at the wall? You've got to do something new. Guys, I hope this sticks the chord with you. I hope that there's something that I'm saying here that resonates with you. We want to help. We look forward to hearing your phone calls come in. If we don't answer the phone, please just leave us a message. We look and are excited to talk to you. Give us a call, 888-287-1030. Find my extension in the phone tree and give us a call. I wish that you can have the financial freedom that you deserve. Call me soon. Thank you very much for spending your time with me today, and I look to answer your calls immediately.